Thank you, everybody, for joining this exciting panel on securitization at our ICMA annual conference. I would like to start with an introduction of the panel. My name is Natalie Westerbarkey. I'm a managing director at ICMA, and I'm very happy to welcome Ms. Maria Green to my right from law firm A&O Shearman, and next to her, Ms. Gina Hartnett from Schroders, so very much covering also the investor side, but the market practitioner. We also had actually invited Alex Lindner from BMP, but very unfortunately, last minute, due to a private situation, he was unable to attend. Right, so maybe before we start with this panel, we thought it would be helpful by show of hands to know from the audience who is very engaged in securitization as a market practitioner or from a policy perspective. So just we can sense a little bit where to pitch. Wonderful. So I see there's at least half that seem to be very familiar, or at least familiar with it, which is good. So with more guests arriving, which is as many seats here still at the front available, and here on the left side. So feel free to come in. Thank you for joining. And let's kick off with our, let's settle just briefly with our first question. So we have prepared a couple of rounds of questions, but we are very happy to take Q&A from the audience in between and also at the end. So let's launch our debate. The first is, what do you think about strengthening securitization through regulation? Is that actually true or false?
Am I allowed to say true but false? I think that's the only way I can describe it, really. And I guess, you know, many of you have put your hand up when we asked about involvement in securitization, so you'll know the travails of the post-GFC EU framework, the 2019 securitization regulation, and where we're headed now with the, you know, the current framework work that's going on, you know, right about to start trilogues for the new regulation. But I guess, you know, the big things for us as people that have been living and breathing securitization over the last decade or two or a bit more, Maria, is that, you know, we had this framework in 2019 that came in that was complex, conservative, you know, all of which made for a very stable and strong securitization market, dispelled some of the stigma of the GFC, wonderful, but it depressed issuance. Investor participation is low. European market remains a shadow of its pre-crisis self. You know, it basically made for a smaller pie. And you know, if we listen to the ideals of the SIU and securitization as part of that, what are we aiming for? A bigger pie. Is it going to work? Good question. You know, the direction of travel with the EU reforms is really a game of two halves. There's the nice political winds behind us, pushing us, if you like, to open things up, to make things easier. But is it really? You know, there's still, I mean, when we're down in Brussels, Maria, we're talking a lot and we're hearing, but the GFC, which seems a terribly long time ago for a lot of us who have been doing this for a long time, and a lot has changed in that time. You know, they've tried to broaden in the investor base, you know, but in actual, you know, by encouraging insurers and more UCITS participation, lower operational burdens. But you know, is that really going to work if we've got a distinction between third country issuance and European issuance, for example? I'd say false when we go to that in that direction. Likewise, if we've got sanctions that are punitive, you know, is that going to help? That would be a false. There are some truths in there, though. I think, you know, there's a cautiously optimistic view from the market generally on some of the more prudential side. And I wish Alex was with us because he'd probably talk to that in more detail from bank side. I'm an investor. I'll, you know, put my hand up there that I'm only going to give the investor view. But I think shall we say, in the EU for sure, the proposals lack some ambition. If we turn to the UK, however, and the PRA-FCA consultation that's just closed last week, the smarter post-Brexit framework, shall we call it, which seems to be aimed to be removing regulatory friction, principles-based, less prescripted. I would say that's probably headed in the direction of true, if I'm honest with you, Natalie. So very, very hopeful. But that was a consultation. We still have to see what comes out in due course. And I think one of the things that we always have to think about, if we're thinking about the size of the pie and increasing that pie and making it bigger, for us as investors, we need issuers to be wanting to create the pie for us. I think there's still a huge gap between what's happening this side of the pond and that in the US. At Schroders, we're both sides of the pond in the securitization market. And just looking at the size of that pie, it's a very small pie still. We can only hope that it gets bigger.
Well, thank you very much. And Maria?
I think my answer will be neither true nor false, in the sense that, to me, and as a lawyer, I really want to know all of the details. I want to have everything in place before I can tell you where we're likely to land. And unfortunately, from now, it will take at least another couple of years before we will know all the bits and pieces in the EU reforms, because there are lots and lots of mandates, technical standards to be amended, or new ones to be developed, or other new guidance to be developed in order for the securitization framework, and that encompasses prudential and non-prudential reforms, to essentially operate as amended in the final form with all of those bits and pieces together in place. So it gives us the full picture, what exactly is going on. So I would say, I would probably be in the unclear bucket until have all those bits and pieces in place. And then I think once we have all of that in place, which means that the whole regime is fully implemented. And remember, once securitization reforms were introduced previously, which became applicable from 2019, we also existed in quite an unhelpful state of limbo for quite a number of years until we had all the technical standards and guidance and other things in place, which was incredibly unhelpful because you were working on transactions, right, subject to the new regime, but it was also subject to other technical changes and guidance that was coming. And then out of the blue, you can be hit by a Q&A from the Commission or BA or somebody else who kind of starts saying something different from what you assumed the regulations meant to require you to do in order to comply. So I think we are not going out of the woods. And even though I absolutely agree with you, Gina, as we discussed before, I think the general direction of travel in the EU is absolutely helpful. They're absolutely saying lots of very right things, that the prudential treatment of securitization for insurers and banks should be more risk sensitive, should really reflect how the market operated so far, the low kind of rate of defaults on transactions. And generally, the market has got a really good story to tell, but that's not how it's treated in the prudential, the regulatory capital framework for insurers and standard formula insurance and banks. But that's potentially changing. That's really positive. We need to wait and see where the trialogue will land in the EU on the bank capital kind of regulation changes. But hopefully it will land in a place where there will be some incentives created for banks to issue and to invest in securitization as far as regulatory capital requirements are concerned. The question is, which ones? There are definitely lots of drivers created for the growth of SIT market, significant risk transfer trades, and that is probably going to be true for both traditional and synthetic transactions. But then there's a big question mark in terms of role of insurers, whether their role will grow or shrink. And the way that the reforms are currently being proposed, they actually can, probably in an unintended kind of way, that's not what the Commission or others probably had in mind when they were introducing safeguards for insurers provided unfunded credit protection to banks in synthetic structures. But the way the safeguards are being structured and how capital rules are being amended, it actually can result in the absolute negative impact on the market and shrink the role of insurers in that part of the securitization market. So it's almost like, to me, it will probably need to be put to the test. And it's only when we start applying the new framework, the changes, that people will be grappling with, like, okay, does it work for me? Can I do the deal as I want to? And also remember, and also some of you will be well familiar with that, others less so, the way securitization is defined, and that's been true for years, since we first saw risk retention rules in 2011, introduced in the EU in the aftermath of global financial crisis. It's an incredibly broad definition. It essentially doesn't require any sale, doesn't require any issue of bonds or any securities, doesn't require any transfer of any assets or anything of the sort. Essentially, it turns on credit risk tranching, and it actually captures lots of fund finance structures and banking structures that nobody even thinks of as securitizations.
That's a very interesting point. Actually, that's a question I wanted to ask a little bit deeper, because I saw from the show of hands, half of the audience might not be as engaged with securitization. So you mentioned the definition of securitization currently under the regulation. So the definition used overall is very, very broad. But not all types of securitization are captured by the regulation. So can you give a little bit of guidance here? Is there, of course, without being too technical?
It's impossible. It's pretty impossible. Because the definition is so broad, if you are in this very broad technical definition that turns on credit risk tranching, ongoing loss sharing, subordination of losses, you could be technically securitization, even though nobody in the market would ever describe your structure as securitization. But if you could by it, you are in scope of the potentially burdensome securitization framework and very different capital treatment for insurers and banks. So I think this is probably number one question in conversations we have, including with asset managers like Schroders, in terms of, I'm investing in X, Y, Z, am I caught by the rules?
And I think that just illustrates one of the biggest problems with securitization and regulation, because I can't quite see with the blinding light here as to how many of you have glazed over already. But the person that runs the strategy, the securitization strategy at Schroders, says if you can't explain it to your mother, then you are failing. And I think we show, by just this exact example, we can't even define it. So is regulation for securitization working? It's a bit difficult for the person on the street to know, number one. But number two, I think we're losing our regulators because we are so technical, and we've been doing, people that practice securitization, shall we say, often get into the weeds so quickly that, when we've been speaking to MEPs in Brussels, they don't really care about whether it's securitization or not. They want to know the impact for their constituents. And if we try to tell them, the GFCs long ago, there's all this wonderful prudential regulation in place for banks. Insurers are regulated, to the hilt. Everybody that's participating in the securitization market is completely regulated. So we don't know why you're worrying about whether or not there's a template for this type of thing. They're sort of like, well, the GFC happened, that's why. And that's not the right answer, as people who are in securitization know. But the problem is we're not explaining to them, or the message isn't getting through, that quite simply, securitization, and I'm going to be really basic here, and you're right, Maria, we spend ages turning ourselves into knots to figure out whether a transaction we're trying to achieve is a securitization or not.
There is no consensus in the market. You can have one structure, two investors, one treats it as securitization, the other one doesn't, the same structure.
And if we can't sit down with a sort of person, an MEP or a person on the street and say, what the securitization actually does is enable that bank to fund, your local whatever shop, or mortgages, or and sort of really put it into a very simple terms, which I'm not doing very well at all myself. Just goes to show how imbued I am with the securitization market. But if we can't do that, we're kind of losing. But in actual fact, securitization is not this evil instrument. It's quite simply a very safe financing tool.
Asset-backed finance. You've got asset, you've got collateral, you can raise money against it. For
it should be simple.
Transfer purposes. Yeah. And actually, this is probably a very good point. Also, elaborate on further, because this is where it's a very different story in the EU reforms and the UK reforms. So in the UK, there is very clear recognition that securitization is quite complex, and there may be also in the market disagreement among how different market participants treat different structures, what is securitization, potentially what is not. The UK is very, very live to that, and actually in the most recent consultations that was just closed, one of the kind of key papers in the consultation was the discussion paper on scope of conduct rules, in recognition that, yes, for prudential purposes, securitization is securitization, so for buying capital rules, it's the same definition is not going to change. But if it is quoted as a securitization, is it appropriate in all cases to apply risk retention rules, very complicated transparency and reporting requirements for kind of loan-by-loan reporting on your underlying assets, or certain credit granting standards? So there is an open kind of discussion paper in terms of consulting with the industry, tell us where the structures are caught as securitizations, but it's quite unhelpful, sometimes probably makes no sense whatsoever, to also require those structures to comply with certain conduct rules, which is incredibly helpful and quite different from the EU, where they're still thinking about one size fits all. And if you see how, or if you're at the roundtables with lawmakers, co-legislators in Brussels or Paris or Strasbourg, you can clearly hear them talking about the reforms and requirements, but they have the most plain vanilla deals in mind.
And I think there's two parts to that. They have plain vanilla deals in mind, and they see securitization as a bank tool. Yep. And banks are the only participants. At Schroders, obviously, we're not a bank. We participate in securitizations. We structure securitizations. We buy securitizations. Banks also structure and buy securitizations, and there's lots of people that are not banks that also use securitization funding. So, there's a sort of limited view on in Brussels to some extent as to the use of securitization, the users of securitization, shall we say, and they therefore assume one size fits all. But I think what the other big thing about this is cost. And so if you fall within the securitization regime, under the existing rules, you have to have put, your transaction has to put in place a whole reporting regime. And if you are purchasing a securitization, you have to put in place a compliance regime to make sure you've checked the box against the regime as it stands, the regs as it stands. Fine. That's a cost. That is also a barrier to entry for both issuer and new issuer and new investor. People like us that have been doing it for 20 years or whatever more, and banks that have been using securitization as a tool for a long time. That's in place. That's fine. I guess, what we're talking about here, however, is something that's more substantive. While we're putting in place, let's say a new investor in the securitization world is putting in place a checkbox regime, embedding that, using financial and human capital to put in place a regime that will tick the boxes for the regulations purposes. They're not doing the substantive work. Do we use the templates, for example? They're illustrative, they're helpful, they can be, but we use what we need to do in order to meet our underlying investors' regulatory guidelines, whether it's regulatory or investment guidelines.
That is an excellent point, effectively, which brings me to something summarizing also that what you said about the policymakers, right? That they would probably benefit from sort of looking at it as the whole ecosystem, from issuers to investors to the intermediaries within the entire securitization process. But is there also, beyond that regulation, that they're trying to get right and trying to improve? And we see big efforts here with the Savings and Investment Union, also increasing the thresholds in the UCITS framework, for example. Is there maybe a way for the industry to come up with standards that would help grow the securitization market and not just leave it all to the regulators in Europe?
So I think the challenge number one is that if there is a desire in the regulatory framework to prescribe regulatory-driven standards for reporting, the job of the industry is to try and persuade the people in charge of those regulatory requirements to align them as much as possible with market practice. So far in the EU, we failed to persuade the relevant lawmakers, regulators in charge of the project to do that. But the door is going to be open under the EU reforms to have another go, because one of the big aspects of the EU reforms includes simplification and reduced burden of compliance with prescribed reporting requirements, templates applicable under the EU framework. And we don't know exactly who is going to be in charge of the project. That's to be decided, which is also going to be important for the overall delivery and outcome, and how long it's going to take, how bureaucratic it's going to be. But essentially, we are going to be reopening European reporting templates for loan-by-loan reporting prescribed for different asset classes, and essentially have a go at simplifying those templates. But as long as EU wants to have a template, I think it's still going to be a problem for the market, because even if the industry is developing industry-driven standard, it's a live animal, right? You want to be able to reopen it, adjust it, reflect, and have certain flexibility built into anything that industry-driven standard, as opposed to regulatory kind of prescribed requirement, which by definition very often very rigid. And this is where, again, EU is very different from the UK, because the UK proposals on the second phase of post-Brexit reforms actually move in the absolutely right direction, the UK transparency requirements, because post-Brexit we've inherited in the UK the essentially EU framework. So currently the templates that apply in the EU and the UK, they're practically identical for asset level reporting for different type of asset classes or investor reporting. So all of that is going to be changing in the UK. The UK approach going forward is going to be, okay, we are removing pretty much most of the templates completely. And we are moving towards principles-based approach, descriptive rather than prescriptive approach. So instead of saying, use this, and this template, to say, okay, if you're in this category of asset classes, like residential mortgages being one of them, because what UK regulators did, they kind of conveyed a series of small group discussions with buy side and sell side, and we're trying to get a better understanding, do investors use residential mortgage template? Largely the answer was yes, so they felt, and do issuers find it problematic? Again, largely the answer was not really. So everybody broadly agreed this is kind of not far from the market standard. Okay, we're going to keep it, but we're going to simplify it. Similarly, they've done similar exercise and maintained templates for a very limited number of other asset classes, but for everything else, the templates are gone. Instead, there's very high-level principles, very, very high-level principles in terms of what to provide, but it's not prescriptive, it's descriptive.
And what you've described there, Maria, is a situation where the PRA, FCA have engaged with the industry, have engaged with both
Really
buy and sell side and listened. And I think, you know, to your point, Natalie, we're in a situation where regulation is no longer, or should be no longer, the binding constraint, but that it's not the catalyst for our behaviours, but market behaviours are, if you like, regulating themselves, and having really good dialogue with our regulators is hugely important, and that will enable, because what's pushing securitisation now, it's bank balance sheet optimization needs. It's investor demand for yield and diversification. It's not, so you don't want regulation changing that. I mean, it will, because there's prudential regulation in place. But I think actually, Natalie, I'm going to swing the question back to the moderator, if that's okay. But, trade associations, that is where bodies like ICMA, I think, we need, where there needs to be a real dialogue, and your views on that?
With pleasure, yes. So ICMA stands ready to support the industry, and specifically, I think, in the area of standardization, documentation. I think that is definitely a key role to play, and we hear that a lot from members. So that's why we also have internally really done a gap analysis and a path to more securitization that ICMA can offer a solution for. That's something we will be definitely focusing on, because we also think that that's our strength, seen in sort of other product areas. And it's sort of the pre-step to making hopefully no longer regulation required. And that would be the optimal solution, that it'll be industry-led. And that's where we actually hope we can help grow the market as well.
That'd be great.
Of course, through training and education. This is the other area that we obviously known for as a core competence. And I think in these two is where as a trade association we can help. But I wanted to go back to one of the things that mentioned earlier. Unless there are questions which we're happy to take. We have about sort of 5, maximum 10 minutes left. But when we spoke about the templates, right? And would that be a possibility to scale perhaps the more traditional securitization asset classes versus the more, specific or thematic ones on green or synthetic?
I'm going to talk up my book and my role. I'm involved in structuring of private securitizations more than on the sort of main market-driven securitization. So RMBS and CMBS, and that end is not me. I do the private stuff. And if I'm honest with you, as I said earlier, securitization is a financing tool. It's a safe financing tool. Whether we fall into the definition of securitization or not is sort of the question that often I spend too much time on. But to your point, I think, yes, there is a whole world out there. And indeed, SIU, sort of the pronouncements from the EU have been really crystal clear. Lending to SMEs, lending for green transition, lending for digitization, defense spending has been another area, and that's quite a tricky one, as you can imagine, with some investors' guidelines. Other forms of sort of innovative, if you like, asset classes. And actually, I would go on to say that the PRA-FCA consultation, by being more descriptive and less prescriptive, actually future-proofs sort of new innovative asset classes. I mean, I'm pretty sure that if I'm still doing this job in 5 years' time, and I hope I am because it's so much fun, that there's asset classes that we don't know about now that I will be securitizing for sure. And therefore, to have some kind of template that, as opposed to some really, substantive review of what we're buying, we don't use templates in private securitizations. Of course, we have to have them if we have to have them. But from the other direction, we're looking at the substance of the asset. We're assessing the substance of the asset. So therefore, we would like to be enabled to do that and spend more time on that, if it makes sense.
Maria, would you like to say something?
No, I was going to say, actually, the other kind of big difference between the EU and the UK, where reforms are landing, is that the UK framework is much more agile, to Gina's point, that the way now majority of the requirements are parked in the rule books of our UK regulators, as opposed to hardwired into legislation that requires approval of the Parliament, Council, or trilogue if it's a level 1 legislation. It's much more cumbersome, it's a complicated process. The UK regime is already much more agile, much more fit for purpose. It already encompasses certain procedures where you can waive or disapply certain requirements on requests. Again, to your point, it's actually much more fit for purpose in terms of future-proofing and make it much more suitable for what the market, how diverse the market really is. And the other thing I think, we're discussing in preparation for this panel, the one thing I was also kind of looking quite closely and when I was thinking about the impact of the reforms in the EU and the UK is primary versus secondary market. Are we potentially heading towards more liquid, deeper secondary markets, which are currently lacking? And this is where we're in a bit of a carrot and stick situation as well with the reforms.
And I think actually, if Natalie, back to what you were saying earlier about ICMA and the role of ICMA in this, secondary market, that SRT is a new securitization tool, significant risk transfer, the bank capital transactions. There is a slow but starting secondary market in those at the moment. It's small. But I'd like to say that the greater the secondary market, the bigger the secondary market, the bigger the pie. We start to talk about the pie
about
again.
Synthetics primarily here.
Yes, synthetics.
Synthetic securitization.
That is an excellent point. The larger the secondary market becomes, the more liquidity, and then the bigger the pie grows. And I think where also ICMA can add the value is that we cover the entire value chain of the market. So buy side, sell side, the market infrastructures, public sector issuers, etc. And we only have, let's say, a couple of minutes left, but I wanted to very briefly turn the attention to the AI and what does all that mean to securitization. Is it going to be a benefit or is it going to make things less easy?
One of the things that's been a real headache over the last, I'd say, 6 months was Tricolor 6 months ago. But Tricolor and MFS, Tricolor in the US and MFS here, the double pledging conundrum, if you like, which is obviously fraud. Can AI help us? Will it make it? Is there a way that AI can prevent, if you like, or detect the potential for double pledging of assets. That would be one of my challenges. It would be wonderful if it did. If there was, we could know that there's a fail-safe, non-double pledging, non-fraud element to AI. But or will it just create more? I don't know. Why not?
Maria?
I think in the context that you described, it can be double-edged sword. It can be used very effectively to counter fraud as well as misused to create fraud. So I think it's a space to watch, and obviously the market is very focused on kind of again best practices, and various trade bodies are looking very closely at how existing kind of things that people do on transactions can be improved. So definitely watch this space in terms of certain market standards evolving with the assistance of trade bodies, including ICMA. But I think it's definitely a tool that will be used, and already actually used for reporting the analysis of deals, testing cash flows.
Hugely powerful, wouldn't it?
It's only going to grow, the use is going to grow inevitably. And then it comes down to securitization of certain assets with AI.
That's great. So it can be an enabler, but we need to watch it also from a security type point of view. So I think with that, we're now running out of time for more questions. I think there's one question. Okay, we will take one. Thank you.
Just one then.
Yves, over to you.
Concerning the subject of disruption, you mentioned this possible disruption. If we add covered bonds and MDPs, multilateral development banks to the equation, the disruption becomes even larger, no? Or you would disagree?
So obviously there are reforms proposed in the EU where they disapply various requirements and kind of simplify the framework for certain structures where you have multi kind of virtual development like EBRD of this world, EIB, EIF, kind of as investors. I don't think necessarily it's a huge share of the market. I don't know how much more role they're going to be playing. I think the biggest disruptor potentially going to be the idea of EU securitization platform. Not exactly, but maybe something like Fannie Mae, Freddie Mac in the US. So I think right now this is very much something that the EU is focused on in terms of what that platform may look like. And again, watch this space for sure, because I think if that comes into play, that will have a potential for not disrupting the market, but it will be interesting to see how it will impact on dynamics. And again, like I think the industry ask is that it's all very well, the EU platform may have a role to play, may be important to spend time to developing, but it should not come at the cost of not getting the rest of the reforms right, including the carrot and stick, where on the one hand, you give this more proportionate due diligence, incentivizing investors to invest in primary and secondary markets, right, making it easier. But on the other hand, you give them a stick by introducing potentially pretty problematic sanctions. There's a big question mark why they should be introduced at all, specifically for non-compliance with due diligence, if there are sectoral legislations in place already dealing with the same stuff. So I would say, yeah, watch this space on the EU platform and the role of the public sector.
And I would simply say that if it makes sense and it works well and there's relative value as an investor, we'd be very interested. So hope it does.
Yeah, and if you kind of invest alongside like EIB, or like all this, like it kind of, they almost like underwrite the quality of the deal for you, because then the whole bunch of other requirements will potentially be disapplied because it's considered high quality almost, right?
It goes back to the pie. If the pie increases as a result of reforms enabling better and stronger issuance from MDBs, and it's already seeing in some sectors of the market, then more of it, please.
Perfect. Thank you so much for that comprehensive but yet sort of punctuated response on the question. And with that, I would very much like to thank, first of all, the panelists, Gina and Maria. I would